Hey, Bowtie Nation, Joseph Hogue with the Let's Talk Money channel here on YouTube. I want to thank everybody for being here. Welcome to another one of these informal videos where we're tracking the stock market crash all the way down. It seems every single day we hit a new low. The futures trading on the markets were actually positive last night on the back of a 750 billion euro program out of the ECB to prop up their economy. But then here this morning we see that looks like the stock market is going to be down again today. So really seems to be no stopping this. And I know this is a stressful time for you looking at your investments. And I want you to stay rational. These informal videos are just a way to stay rational, stay focused on your financial future, and kind of help you figure out where we're going from here and how to chart your path here. So what we're going to cover today is just how bad can it get. Okay, we covered a little bit of this on Tuesday in our other informal video talking about the numbers there, but I want to talk about the actual index values, how far low they can go, and when to start investing back into this market. We're also going to talk about some recession stocks and assets. So what can you invest in that maybe is going to protect your money, is going to help you take advantage of the rebound when it does happen. And then we'll cover some of the news that we're seeing over the last couple of days. Again, I want to invite you to join the conversation in our Facebook group, our private Facebook group, over 1,000 members in there, having some great conversations every day on the market, some of the best stocks to buy. So I will leave a link to the Facebook group in the description below this video. So let's get started. Let's get started with how bad can it get, because again, we seem to be hitting new lows every single day. When I first warned investors about the coronavirus there on February 19th in a video about how it could get much worse, I didn't think the market was taking this thing seriously. And of course, that next day it started that what's now a 30% plus drop in the markets. Even I didn't know how quickly it could become so bad here. I had trigger points where I was going to invest a little bit of my money at 15% down, 25% down, 35% down, and then 45% down. And of course, those first two triggers where I took some cash out of my portfolio and put it back into stocks at 15 and 25%, those happened very quickly. And it looks like we'll trigger that 35% level maybe here in the next week, and then who knows how far we'll go. So this is quickly devolving into kind of a panic situation. And you look at stock prices and they're normally based on earnings, but there's really two problems here. One, we have no idea what earnings are going to be for a lot of these companies, especially in the tourism and hotel related fields. Their earnings are going to drop to negative. Their sales are going to drop to zero. Their earnings are going to be negative. So you can't really say, okay, prices are down 30% from the peak, they must be a good deal right now, because if you look at that common price to earnings ratio, then yeah, prices have come down, but earnings have also come down much faster. So you can't necessarily look at this market, look at it every day, new lows, and say, hey, this must be a good price to buy at. So you really have to get a feel for when you think the market could stop falling, or even as you get on the way down, and start investing there. Goldman Sachs is actually calling for 2,000 on the S&P 500, which would be about 40% down from the highs in February. I think it could get even worse, just as the sheer numbers of cases infected and deaths rise, and people really start quarantining. Okay, if you look at what's happening right now in France and Italy and Spain, and even across the larger Eurozone. They have massive shelter-in-place mandates where it is not only requested, but it is mandated that you stay in your home. You can't go out other than for groceries or for pharmacies. Pharmacies and grocery stores are the only things open across most of Europe right now. And in fact, here in the U.S., I think we'll see a lot of that. Just if you just look at those numbers, and again, we covered a lot of this on Tuesday, so please watch that video. I'm not going to cover the numbers again because I want to get to these recession stocks and what you can really look for. But I mean, it is expected minimum hundreds of thousands of deaths here in the U.S. from this, and millions of infected cases. And we are just now at about 10,000 infected cases and a couple hundred deaths. So if you just think about those sheer numbers, and the emotional cost and the psychological toll it's going to have on people, then you can't help but wonder, okay, what kind of an effect is that going to have on the markets? Even if the economic effect it maybe a little bit more muted, you're going to have that physical and emotional pain on people that is going to find itself into the markets, and I think it's going to drag these markets very much further down. Now, again, and also what really worries me about this is kind of the healthcare services and equipment shortages that we could see, and that will almost certainly add to the panic. Okay, if you look at the balance sheet of most hospital services, medical device companies, that kind of thing, or hospital services and that, then the margins are so tight on these. Okay, so you've got profit margins of in the single digits, 2 to 5% on these companies. And that just means that they can't afford, in normal times, they can't afford to have huge amounts of staff just sitting around as excess capacity. Okay, they can't have a lot of empty beds in the hospital or in that ICU unit. So, and that's fine for normal times. But what happens when we get this pandemic environment, when we get this epidemic and this virus going around, they just don't have the capacity to meet this. We do not have the number of respirators that we're going to need for this. We don't have the number of hospital beds or just the hospital staff to serve all these people that are going to be rushing into this. So I think, if you look at Italy, that's what's happening right now. People are sleeping in the hospital, sleeping on cots in the hallways because they just don't have enough beds. And obviously it's making recovery nearly impossible for a lot of this portion of the population that goes critical with this virus because they just don't have the respirators to help them breathe and to help those symptoms. So I'm thinking, within the next month or two, we're really going to see the worst of this pandemic in the United States. Like I said, we just crossed 10,000 infected cases, a couple hundred deaths. But we are putting on, I think yesterday was just under 3,000 new cases. Day before was about 1,500, and the day before that was 750. So you look, this is rising exponentially. And I think it is going to be very soon when we actually start this testing on a massive scale, that we're going to see 10,000 new cases every single day in the United States. And so that gives you kind of an idea of the scale that we're looking at here and the level of panic that could kind of grip society and the markets, and give you an idea of why I think the markets could go much further. Again, I think we're probably going to be at least June or July before we really know how far this can go, and almost definitely still dropping through April and May. Right? It's about mid-March right now, so I think you're definitely looking at lower prices in April and May as those number of cases ramp up exponentially in the United States into the hundreds of thousands. But what I want you to think about here is don't think so much about finding a market bottom. Okay, nobody's going to be able to find the market bottom, and like I said, I think it's going to get much worse from here anyway. But just about being able to take advantage of these prices on the way down, and then just hold your stocks. There is a massive amount of stimulus being put into this economy, more than estimated up to $1 trillion in the United States. Same numbers in other countries. The Eurozone, like I said, just announced that 750 billion euro package. More may be on the way from them, and in the U.S. we're passing multiple packages, to prop up the economy. And the thing about this, it is so quick. This virus moves so quickly that it could just be 3 quarters this year. It could be first, second, and third quarter of this year where we really see those economic effects, and then in that last quarter of the year, we're back to business as usual. And with all this money jumping into the economy, with interest rates at near zero, then you can't help but get a rubber band effect really in the economy. And of course, I think stock prices are going to bounce back fairly quickly on that. So what we've been talking about lately is in these videos is having that plan. Okay, so we're at 30% down right now. If you've got cash available to reinvest in the market and take advantage of these lower prices, then I think you can do that maybe at when the market hits 35% down. So that's right around 2,200 on the S&P 500. Maybe you invest some of that cash then. Maybe you wait till 45% down to invest some more cash. and maybe even as far as 50 or 55% down. You're just trying to take advantage of, as low as the market can go, and not trying to be stressed out about this market. Okay, so one of the best things about this plan is that when you're going to invest some of your money, right? When you're going to get back into the market with some of this money, and you don't have to watch stocks every day. Okay, stop watching stocks every day, folks. It's just going to stress you out needlessly. You cannot control where this market goes. Don't try to find the double or triple digit gainers that nobody else has found. So make a plan there. Now I want to cover some recession stocks and really what to be looking for, right? And right now the answer to that is really easy because it's kind of nothing. Okay, so even the best companies, even some of the companies that we'll talk about, some of the sectors and the assets that we're going to talk about right now are being dragged down with the rest of the market just on that sentiment. People are selling what they can, anything they can for liquidity. They have bills to pay. They know they're being laid off, that kind of thing. People are selling what they can, not necessarily what they want to. Okay, and that's a true definition of a panic environment, is when people are just rushing to sell whatever they can, whatever's most liquid. So even some of the good assets and the stocks and the sectors that we'll talk about are being dragged down with the rest of the market. So I think you can wait a little bit, kind of watch some of these sectors, watch some of these stocks, and then start picking them up as the market falls further and as they get dragged down further, because I think some of these are going to help protect your portfolio, plus give you a chance to ride that market wave back up when it does rebound. So first we'll look at some traditional safety sectors. And so what I'm talking about here is the stock market. The economy is broken down into sectors, right? You've got utilities, consumer staples, you've got technology, things like that, a wide group of companies that all compete within that same product category, right? These are sectors. And these sectors all react to the economy and to risks differently, right? So you've got those traditional safety sectors like staples and utilities, consumer staples, where the sales are relatively stable, okay, compared to maybe tech or industrial goods or things like that. So consumer staples are things like food and household products. People are going to buy those things no matter how bad the economy gets, because they got to eat. Okay, people are going to pay their utility bill for the most part, no matter how bad it gets, because they need heat, they need electricity, and so forth. So these companies and the stocks within these sectors traditionally don't lose as much as the rest of the market. Okay, they still get pulled down because, again, even those utility companies, they have to promise not to cut people's services off if they can't pay the bills during these recession and these hard times. So sales do come down a little bit, just not quite as much as obviously the hotel companies or the airlines, things like that. So we're going to look at what I want to do. I want to look at the Spider sector tracker. Okay, and what you're looking at here is the sectors in the economy, the 9 sectors of the economy, plus the S&P 500 index, right? And we will switch this to year to date. So these are the 9 sectors of the economy plus the S&P 500 market index. You can see here the S&P is down a little over 25% at this point year to date. And then you've got each sector, and what you can do is really look through these to get a feel for those safety sectors, how the sectors are doing, and of course eventually maybe jumping into those hardest hit sectors when you think the market can rebound. So if we look down here, we obviously see, okay, yeah, those traditional safety sectors like consumer staples only down 11.5%, utilities only down 14%. Okay, you've got those safety ideas. Now, there are a few things to remember when you're looking at these. Something like technology. Okay, certainly not a safety sector. Technology is one of the most cyclical sectors there. And this 18.6% down year to date is a little confusing. And what we see here is in a lot of these is the difference in the different industries within that sector, right? So within each sector, you've got lots of industries of companies that are competing in slightly different products. So in technology, you've got massive losses in some of those maybe consumer technology companies like Apple, but you don't have quite so much in the losses in other companies like Microsoft, Cisco, The companies that we've been talking about, that we talked about on Tuesday, that might actually benefit from this. Okay, Netflix has done comparatively well. Other companies like Fastly have done comparatively well because they provide services in that media and streaming content field. And of course, if people are trapped in their homes, they're going to be watching a lot of content on TV, on their computers, streaming a lot of content. So even looking within these sectors, you kind of have to look deeper into some of the industries that may or may not do better and some that might be affected. Real estate, we're going to talk about that in a little bit with the assets. We're going to talk about bonds, real estate, and gold as safety assets, so we'll get into that. And then you look at some of these other sectors. So energy obviously has gotten massively hit hard with the price war between the Saudis and the Russians. Oil is down to about $22 a barrel. It hit $20 a barrel yesterday. We'll talk about some of the news around that here pretty soon too. You've looked at some of these others, and you've got healthcare, which is obviously doing a little bit better. Healthcare services are going to increase, but then a lot of these hospitals are probably going to have to eat some of that bill for uninsureds and some of their overload patients. So not necessarily one you want to jump into, but one that should do relatively well against the rest of the market. And you look at some of these sectors that have underperformed, so have performed worse than the S&P 500, worse than that 25%. Again, we have energy here, we have consumer discretionary. This is going to be all your retail companies, your things that consumers don't necessarily need to buy. Maybe they want to buy those new shoes, but they don't need to buy them when there's a recession. So obviously those get hit hard. Financials here, let me tell you folks, the banks may look like screaming deals right now, but it is going to be very hard for a bank to make money at these interest rates. Okay, with interest rates on the 10-year bond at 10%, at the 30-year bond, it is going to be very hard to make money because they're just not making any money when they loan out. So it's going to be very hard for consumer lending banks, especially. So you're thinking things like Wells Fargo, the regional banks. If you're going to invest in financials, I would invest in the larger market-oriented banks. Okay, so we're talking banks with a capital markets exposure, like J.P. Morgan, like Goldman Sachs. So these banks do some lending, but a very much larger portion of their sales or of their revenue is from that capital market. So trading and that kind of thing. You've got other ones here, industrials and materials, obviously underperforming because they're much more cyclical stocks. So that gives you an idea of some of these sectors in the economy, how they're reacting to this market. Some of those safety sectors like staples and utilities, consumer staples. And so if you still want that market exposure, you might be able to invest in those sectors and be able to keep your money in the market, but not lose quite as much as some of these other sectors. Now, I want to also talk about stocks that could actually benefit from this market, and we've been talking about these over the past week or so. And these are not necessarily in those traditional safety sectors, but they're just specific companies and industries that could benefit this. And we already talked a little bit about this with those streaming and networking stocks. Okay, so obviously people sheltered in place, people locked down in their homes, they're going to be watching streaming. They're going to be using the social networks and using those networking services. So like those conference calls and things like that. So here I'm thinking, things like Netflix, things like Microsoft and Cisco that provide those networking services. We talked about Fastly, which is a stock that I'm invested in, which provides those streaming services. That's FSLY. Microsoft MSFT, Cisco is CSCO. So those stocks that might be in that technology sector, so typically very volatile and cyclical sector that loses a lot when the market drops, but those specific industries and the types of stocks that could actually do better. We actually talked about funeral services in our live stream last Sunday. A lot of these stocks, obviously, as that death toll reaches into the hundreds of thousands in the U.S. alone on this, then these are companies that are unfortunately going to benefit from this. So we talked about companies like Hillenbrand, which is HI, And this is kind of a special case here because they get a lot of their money from their revenue from industrial machinery and industrial products. So obviously that's going to take a hit. But then they also sell 45% of the caskets in the United States. So a huge portion of the market share for caskets and other funeral products in the United States. So that should help them relatively, relative against other industrial products companies. We also talked about Carriage Services, which is ticker CSV. It's another funeral services. They own funeral homes and cemeteries across the United States. We talked about Service Corporation, SCI, and that is the largest funeral services company in the United States. So obviously these they're going to see their revenues increase. If you look at the average number of deaths in the United States and in any given year, that's about 2.8 million. And we are estimating a minimum of a few 100,000 deaths due to this coronavirus alone. So, if you take that 300,000 against that average of 2.8 million, that's an increase of at least 7 to 10% on the normal number of deaths in the United States in any given year. So that is a significant increase in the demand for these services that we're talking about. Now, here also, before we get to some of the news that I've been looking at, I want to talk about some of these other safety assets. So we're talking about bonds, we're talking about gold, and we're talking about real estate. And again here, you might look at some of these charts, and we're going to look at a chart comparing these here in a minute. But they've fallen. They've fallen over the last couple of weeks, and people. One of the biggest questions I've been getting is why have these safety assets, these things that are supposed to be protecting your money, why have they been falling? And again, a lot of it is because people have just been liquidating positions in everything. Okay, people are rushing to cash because they don't know how bad this is going to get. They don't know how long they're going to be laid off. They don't know how many margin calls they're gonna get for stuff, so they need to be in cash so they can have that cash available, and they're just selling out of everything. Okay, so now I do want to look at that chart, and what we have here is a chart for year to date, so from January to present, of the SPY, which is the ticker symbol for the S&P 500 fund. Okay, so that's in green here. We've got the BND, which is the bond index fund. That's in yellow. We've got the VNQ, which is the ticker for the Vanguard Real Estate ETF. That's a collection of a lot of real estate investment trusts, which are companies that own real estate. So a good proxy for commercial real estate and real estate investments. That's in red. And then here we've got the GLD, which is the ticker for the Gold Trust ETF. And that just tracks the price of gold. And that one's in purple. Okay, so we've got these four assets, right? Stocks, bonds, real estate, and gold. And you can see, okay, so obviously everything was going pretty well up until about February 20th, and that's when the pain really started. You saw an immediate drop here in the SPY, that green line, stocks, and then and pretty soon after that, the real estate started following it. And if you look at real estate and stocks, real estate really hasn't protected much as it should from the stock market drop. Okay, maybe by a few percent. I think real estate here is down by about 25%, whereas stocks are down by 28%. And the reason that is a lot of these real estate, these commercial properties are just getting slammed. Okay, any kind of real estate, in obviously hotels, the resorts, the casinos. A lot of this real estate property is getting hit hard here, and the office property is going to be very close to that. So I want to leave real estate alone for a minute. I'm going to talk about the different types of property. Maybe you might be able to invest in these real estate investment trusts and how to invest in that. But I really want to look at this gold and the bonds because, of course, these are supposed to be the two assets that are supposed to rise in value during these times of market stress. Bonds, obviously, as interest rates fall, then bonds are supposed to do better, supposed to increase in price, and not only protect your money, but give you a few extra percent on your money. Gold, the same thing. Gold is supposed to be the fear asset. Gold is supposed to be the thing that people buy when they're not buying anything else, when they sell everything else. And we've actually seen gold decrease over the past week. It actually did. So gold is this purple line here, and it actually did pretty well. It rose to into the 1600s right here, March 9th, and that's when both gold and bonds really started to break down. And that's when for gold, you had a couple of things. Gold, One, we talked about everybody's just liquidating everything and going to cash. Okay, even against gold, cash is king here. So people started selling gold, but also within gold, you had a few other factors. So two of the demand factors in gold, jewelry buying. Obviously, people aren't going to be buying a whole lot of jewelry if they're worried about losing their job or being unemployed. So obviously that demand factor for gold has taken a hit. Technology products actually use a lot of gold, and gold is a very good conductor of electricity. So obviously, if we get this huge hit to the economy, fewer tech products being produced, then that's going to be a hit to the demand for gold. So both of those factors, central bank buying. Actually, we've had about 10 consecutive years of central banks around the world buying gold, using their reserves to buy into gold, kind of diversifying away from the US dollar. Well, what happens when these central banks have to put out these huge stimulus programs, all this money into the economy? They're selling reserves, selling gold to have the cash to put back into the economy. So even if the investment demand for gold is still rising, actually, you still have these three other factors that are really limiting the upside potential in gold. With bonds, it's a couple of different things. It's that liquidation. People are even selling their bonds because they're able to sell their bonds. They need cash. But you also get a couple of other factors, right? You get the fact that bond yields are actually rising over the past week. Interest rates on the longer dated bonds have actually gone up a little bit, and that's one because not only are people rushing to cash, they're selling bonds. There's also been some dislocation in the credit market, in the bond market. Not quite working quite how it's supposed to. So that's why the Fed has come in with liquidity at the shorter end of the curve. But the biggest thing here is when the government makes these fiscal programs, this 750 billion euros out of the Eurozone we got announced yesterday, the up to 1 trillion in stimulus from the U.S. government that they're talking about, sending cash out to people, all these bailouts that we're talking about. That money has to come from somewhere, right? So when the government needs money, then it creates bonds, right? It sells bonds for the cash for these programs. And we were already looking at a $1 trillion deficit. Okay, that's the amount of money above what the government collects in taxes each year to pay for all its services, right? Everything the government spends money on came to $1 trillion deficit this year. So the government was already looking at having to sell enough bonds to cover that $1 trillion deficit. Now it's also looking at another $1 trillion of bonds it's going to have to sell to cover these stimulus programs. And investors are just looking at this and saying, if I'm going to support this the market with all these bonds, I want a higher interest rate, right? So that's really what's happening to interest rates over the past week. Investors are saying, okay, well, if the U.S. government is going to have a $2 trillion deficit that it's going to have to finance through more bonds, through selling bonds to investors, I want a higher interest rate because there's going to be more risk there. So interest rates have been going up. Investors have been demanding more interest yield on bonds. And of course, as interest rates go up, bond prices go down. So that's really where you see the pain in the bond market and in bonds right now. But if you look at this realistically, and if you just look at this as a matter of levels, even with that relative pain in the bond and the gold market over the past week or so, these are still only down about 4% for the year. Okay, if you look at the stocks and the real estate market, down 20, 25, 28%. Okay, now let's look at this over the past month, which is really when it's gotten bad. So stocks here are down 37%. Stocks are here down 30%. The real estate, the VNQ real estate fund is down 37%, and bonds and gold are only down 5 and 6% respectively, right? So they are still protecting your money. They're still holding up that idea of a safety asset. Yes, it sucks to lose money in an asset that you thought would increase as the stock market fell further, but it's still protecting you pretty well. So again, I would suggest having some of your money in bonds, some of your money in gold for as bad as this can get. And actually, we're doing a video tomorrow on gold, how to determine the price, how the price is determined, looking at some of these factors. So definitely make sure you check that out tomorrow. Again, I want to talk about real estate again because I love real estate. I think it's a great asset, even despite the fact that it really hasn't protected much of your money here in this market crisis. But real estate is really like those sectors. You really have to look at the pieces of real estate. Okay, so within commercial real estate, within these real estate investment trusts that you can invest in, you really have to look at them by property type. Okay, because there's 5 property types. There's office space, there's storage, there's hotel and leisure, there is industrial, and there's retail. Okay, and then there's actually you could say there's another one with those data centers and digital properties, right? So you definitely don't want to be in some of these. Some of these are getting hit very hard, will continue to get hit very hard, while others might be actually relatively safer places to put your money in. Okay, so for here, I'm thinking obviously retail. Okay, this physical retail, these shopping malls, these department stores. We're already having a very tough time competing with online sales before all of this hit. Okay, we had massive bankruptcies, massive layoffs in this retail environment even before the coronavirus. And this is only going to get worse over the next couple of months. And I think a lot of these retail stores that are closing temporarily for the virus, they're never going to open up again. Okay, we are seeing just a huge shift to online shopping, online spending. It's coming out of that physical retail store, and so I would not be investing in any REITs that own malls, any REITs that own a retail property. Other than there is one, maybe Realty Income, that's ticker symbol O. I know a lot of people are big fans of that company. And a lot of that company's assets, a lot of the retail properties are actually in those less cyclical property types. So they've got a lot of pharmacies, a lot of supermarkets, and a lot of those convenience stores, right? So it might do relatively better than, say, a real estate like Simon Property. Which is, I believe, ticker SPG, which owns shopping malls. Okay, obviously shopping malls are going to get hit even harder than they were already experiencing. So you've got retail, you've got hotel. Obviously, any hotel REITs out there are not going to be doing well over the next few months. Office space is obviously going to get hit very hard as people start working from home. Another trend that we were already seeing before the virus hit, and now that's just going to amplify that trend of people getting out of the office and working from home. And of course, that means less office space is going to be demanded, and these real estate investment trusts that own that office space are going to suffer. The one thing holding these up possibly is going to be that obviously lease terms are generally for years in advance. So they might have some support as people, still have those leases, but you can't collect money from a company that goes bankrupt. Okay, I don't care if a company has a lease or not. If it goes bankrupt, it's not paying you on that property. You've also got leases that are continuously being re-upped. So while you might have some leases on your books that are 3 to 5 years out, you've got leases expiring, and you're going to have to renegotiate those. So definitely a retail, office, and hotel I would avoid right now for those real estate investment trusts. You put that against relatively safer sectors or commercial property types like maybe storage. Self-storage might do a relatively better. You've got ones that we've been talking about, like those data centers. So we talked about digital realty, that's ticker DLR, last Tuesday, and that's actually up 13% for the year. Okay, and against the S&P 500, that's beating the market by about 40%, and it's because they own these data centers that is managing all this streaming traffic that everybody's going to be using. So you've got that. You've got maybe the cell phone tower REITs. I'm thinking things like American Tower, which is ticker AMT. You've got a lot of those digital type properties that you can look for a relative safety in real estate there. So those are kind of the recession stocks, safety assets, and stocks that you want to be looking at during this crisis. So you've got your safety sectors like staples, utilities, the stocks that could benefit like streaming and networking, and then the funeral services, and then you've got the other assets like gold, bond, which while they're falling a little bit, while they are also experiencing the pain, it's still protecting your money. Okay, and I think gold has the potential to rebound still on that risk trade, and then you've got real estate as well. Now I want to talk about some of the news that we're seeing and how this is contributing to it. Okay, so the big news today is that unemployment claims hit 280,000 over this last week. The market was expecting 220,000. It hit 280,000 as people start to overwhelm these unemployment offices. New Jersey saw a 12-fold increase in unemployment claims last week. Connecticut was 8-fold. There was 45,000 people in Ohio over just the last week claiming new unemployment benefits, right? That was a 7-fold increase. So we are starting to see the economic and the employment effects of this virus come through, and it's going to get nasty, okay? The March payrolls, which are reported the first Friday of April, that's going to be really the first one that we see that really shows us the depth of this on the economy. And really for the next several months probably, it's going to be ugly, okay? Estimates for unemployment are to reach at least 6% unemployment. So that's basically about double the unemployment that we had, to as high as 20%. So some people are actually talking about how unemployment could reach into the double digits in that 10 and 20%. So if you just think about this, the market's already down 30% just on that idea. And as we actually start to get there and the economy just grinds to a halt, I think that's going to take the market down further as that realization sets in. So I want to talk about a strategy here for this, and then we'll talk about oil prices lastly there. But so one is just to save your money. Okay, I see a lot of people in the Facebook group asking if they should jump into a specific stock. If a stock is a buy or if the market is a buy. You don't need to look at the market every single day. Okay, let this market work itself out for the next month or so. Even have your strategy for different levels when you're going to invest in your list of stocks that you want to buy, and then just don't worry about it until that point, until the market reaches maybe another 10% down. Then you say, okay, I'm going to put 30% of my cash into this market. Here's the stocks I want. Okay, it's a huge stress reliever to have that plan and not have to watch the market every single day. Another thing that we'll talk about, and this is extremely important, this is probably the best thing you can do, is to have a way to start making more money, making money online through a website, through, yes, even a YouTube channel here. Maybe start freelancing if you can. And I realize that the demand for jobs and freelancers really isn't really high right now, but there are ways you can make money online and not have to spend any money. It costs less than $5 a month to start a website and to start making money through that. And we've got a lot of videos on the channel about doing that, about making money online and through a side hustle. What this is going to do is not only is this going to give you that job security or that income security, okay? So if you do unfortunately lose your job or if you get cut back as far as hours, then you've got other money coming in from other sources that is going to help you pay the bills, okay? But also it's going to give you cash to take advantage of these prices, these lower stock market prices, right? So very important that you look for other income sources and you start on that now, okay? Don't start in 6 months when maybe you get your hours cut or you lose your job. Start now, so in that 6 months, then you're actually making some money and you can help support yourself with that extra job. So I'll put some links to some other videos and some other playlists for videos of ways to make money online and different side hustles. I'll put those in the video description below, so make sure you check that out. Last news here, we continue to see oil slide. It slid 24% at one point yesterday, down to $20 a barrel, up a little bit today, just basically on a dead cat bounce. And it could hit its worst right around April 1st, when the Saudi Arabia is set to ramp up their production starting April 1st. And I think that's going to be a real pain signal for the market. I think oil could go much lower, so I'm not trying to time oil right here, but I think there is a potential for some kind of an OPEC-Russia deal. Okay, this is extremely painful for any country that is exporting oil. So you've got all of the OPEC countries and Russia, and I think they're going to get to a point where they need a production cut. They need to come back to the table and support those oil prices. So again, I want to thank you for joining us for this informal, stock market crash video. Stay safe, stay calm. Okay, you don't have to look at stocks every day. You don't have to call a bottom here. You just need a plan, and we're gonna work through that here. So make sure you join the community by smashing that subscribe button, as we say. Ask any questions you have below. I always respond to the questions, and join that Facebook group. Join the conversation there on Facebook.